Welcome to Leaders in Lending. I'm your host, Jeff Keltner. This week's episode features my conversation with Adam Brice, the Senior Vice President of Lending at EFCU Financial Credit Union. They're a credit union in Baton Rouge, Louisiana. I enjoyed this conversation with Adam. We started off talking about his perspective on what he calls common sense lending and what that kind of means, and really got into a little bit of kind of automated underwriting, AI, and where AI fits with respect to common sense lending and more human judgment oriented approaches to lending. So I thought that was a really interesting conversation. Kind of started and ended with that. And in the middle, we talked quite a bit about the state of indirect financing, of particularly auto lending, and where that is going given the current state of both the auto sales and supply market and the way OEMs and manufacturers and others are moving in terms of how people buy cars. So it's a really interesting exploration of what is coming down the pipe, what the future may look like in auto lending, and also how AI plays into the future of common sense lending. So please enjoy this conversation with Adam. Adam, welcome to the podcast, and thanks for making time to join us today.
Thank you for having me. I'm looking forward to it, and I'm really eager to get to talking about some lending issues.
Let's do it. Well, let me just start by asking you this question, which I kind of ask all my guests. How did you wind up in the banking lending industry? I don't think it's the dream many of us have as kids. What was your path to this place?
Man, that's an interesting question because, I started out at McDonald's as just a crew worker, and I kind of worked my way up to a manager. I was not overly pleased, being there. It was just kind of a starter job as a child, and I was in college, and I was looking to kind of get into more of the financial sector because it kind of interested me. And one of my friends who was a manager with me at one of the McDonald's applied and got a job at EFCU Financial. At that time, it was Federal Credit Union. So she was kind of telling me a little bit about it, and I applied, and I started off as a part-time teller, working 20 hours a week while I was in school. And once I graduated from school, then I became a full-time employee. I started off as a teller, and I've worked my way up over the 15 years that I've been here.
I've heard more and more people started off as a teller. I haven't heard that it came from the McDonald's crew through the manager to the bank teller, but I've heard a lot of stories recently, people starting off in tellers, which I think it's interesting to see the longevity of people in this industry that start off and stick with it. I think it's fascinating. Particularly, I think that's true in credit unions where I hear that story.
Yeah. One of the things that's kind of funny, though, like, you talk about the McDonald's thing. Our chief operations officer started off at McDonald's as just like a crew person, and she started off as a teller here, and she's up to a chief operations officer. Our VP of operations was a crew person at McDonald's. She also started off as a teller here and worked her way up. I feel like, and I'm not saying this, about the McDonald's or the fast food industry in general, but working in type of like a food service, I think it kind of prepares you for hard work, kind of pays off type of thing, because I never worked so hard in my life at McDonald's. We were always always on your feet. You're always moving. You're always going. It doesn't stop. People are coming to get food, and it's just a fast pace. And it was a very difficult and tough job. And you didn't make a whole lot of money at it. And I feel like that prepared me very well for the future, as far as a job that I was kind of looking for, and kind of what type of environment I really wanted to be in.
That is a fascinating perspective, and I think I actually think it's very useful for anybody to have a service related job early in their career to give a sense of what that's like, what's happening. I always try and tell my kids, be nice to the people working back there. That's a hard job; they're working hard, and it's easy to kind of see them as invisible, just cogs in the wheel of getting your Happy Meal or whatever. But it is a hard job, and I think a good experience for anybody. Puts a lot of things in perspective.
It certainly puts the value on a dollar, and working in that type of environment, the fast paced environment, dealing with people and customers, and dealing with their food. It's a tough job. It's a very, very tough job.
Let's talk about a different job for a while now. When we had our earlier chat, you used a phrase that I wanted you to explain what you mean by and then dive into, which was common sense lending. And you say that to me, and the first thing that pops in my mind is the old saying, there's nothing so uncommon as common sense. But I'm curious what you mean by common sense lending, how you think about what that really means, how you apply that in the context of the credit union.
So when I look at review an application, I try to take a common sense approach. And what I mean by that is, does the loan make sense? Is is the member going to pay that loan back? Do they have the ability? Do they have the stability? Do they have the willingness to do that? And an example that I'm going to share with you is this. So let's say member John Doe comes into the credit union and needs a $5,000 loan. Well, member John Doe has a 2008 Chevrolet Silverado with 150,000 miles on it that is free and clear of any liens that he wants to use as collateral. Well, generally speaking, most financial institutions will decline that loan because the collateral is too old, it's out of their policy guidelines, it's not within their procedures. But the vehicle itself was worth $10,000, and John is coming in to get $5,000. So you have a loan to value of 50%. Well, in that situation, 9 times out of 10, especially from the financial institutions that we see around the Baton Rouge area, they're going to turn down that loan. But then John Doe comes and reapplies for a loan, but he's going to go for the unsecured route this time. He's going to apply for $5,000 unsecured. And guess what happens? John Doe gets approved for $5,000 unsecured. So in that sense, why would you want to give someone a $5,000 unsecured loan versus not wanting to give someone a $5,000 loan that is secured? And that's kind of my argument there. If you're going to give someone $5,000 unsecured, why would you not go ahead and do some type of policy exception and approve a loan that's secured? I would much rather have some type of collateral on the books when it comes to, a loan like that versus going an unsecured route. So at that time, I'm willing to go ahead, make an exception to our policy and approve a $5,000 loan on an older model vehicle. If the member were to default, at least we have something to fall back on, and we can go and, pick up the collateral and at least try to recoup some of our losses. Well, if John Doe defaults on an unsecured loan, well, guess what? Most financial institutions are pretty much out that money if the loan defaults. So that's kind of where my common sense approach kind of comes into play.
It's a fascinating point, and I think it's interesting because it kind of points to the fact that most of our policies have blind spots in terms of what they're protecting against. And where do you think that comes from? Because you're right that you can imagine that at a certain point, if you are willing to, you're totally right, it's less risky to put a lien on the car than not for the same loan. Why would we approve one over here and not have the ability to have our policy support, at least the amount on a secured auto loan that we would give an unsecured loan for at a similar rate? How do you think we end up in a world where the policies do that, where they kind of have these strange, because that seems really weird that you have two policies, two products, one clearly safer than the other, and the other one willing to make a loan that the first one wouldn't. Like that, those policies are out of whack. Why does that happen in the context of our policies? It's a fascinating question to me.
It's really hard to explain why that happens, but I just think that the risk that's evaluated and maybe people or employees are not thinking about the context of, well, if you're gonna approve a member for a $5,000 unsecured loan, why wouldn't you just approve them for the secured loan and just make the exception? I mean, in that situation with John Doe, we were in a good position. The loan to value was 50%. I mean, we were in a great position from a loan to value standpoint. We had collateral versus, something unsecured where you have nothing really to fall back on. And, where I've developed that was, before I came into lending, I was an underwriter on our indirect side. So I saw some things that, dealers would send us some older model units, like maybe we see a 2010 unit with 200,000 miles. But the person who was buying the unit was an 800 credit score. They had a 12-year job as an engineer. The loan made sense. And in most of our policies and procedures, we were missing out on loans like that. We were declining them. Other lenders were declining these loans. And once, I kind of came into this role, I saw some of those things, and I felt like that was an area that we could kind of take advantage of. And not to say that I want EFCU Financial to be the older model unit, high mileage unit type of lender. But no, it's more about, taking that common sense approach, seeing what the applicant is, who they are, what their stability, their ability, their willingness is to pay the loan, and if it makes sense, from a loan to value standpoint, maybe the collateral has a little bit higher mileage, but you have a buyer or, an applicant who is extremely strong. They've never had delinquency on their credit report. They've never defaulted on a loan. They've paid everything perfect. So we were missing loans like that. And when I came in, it was some of those changes that I started to make where, we would, instead of just declining the loan, I would just go ahead and make a policy exception and approve the loan. And we've had some outstanding performance on, some of those lending decisions.
I'm curious if you see a world. I mean, I guess I'm starting in the world of AI-based underwriting and approaches. And in some ways, I think of those as kind of, automated ways to have, I think what realistically happens when you apply more sophisticated underwriting is you start eliminating the policies, like let's say a maximum age of vehicle, because you can say, well, the maximum age of vehicle is a risk signal, but I got lots of other risk signals, like the ones I might use in my unsecured. And so while, for like it's riskier to have an older vehicle or a higher LTV than it is a lower, I can kind of understand the holistic risk and incorporate other factors. So I don't have to have a hard policy kind of say, well, that increases the risk and decreases my recovery value. But in this case, it totally makes sense. I would have given the guy the money unsecured, so the risk is still acceptable. And I think in some ways it can kind of automate some of this policy exceptions by really expanding policy and bringing more factors into play at the kind of automated level, as opposed to having to have a human judgment. Do you see that as part of what the opportunity for automated underwriting with more advanced than like the traditional policies, which are, a pretty limited set of things typically that are in the policy, right? It's got to be readable, understandable, usable by a human, or do you think that that's not really where this is headed? It requires some more human judgment to make these kind of determinations.
So I do think it does require a little more human judgment to make some of these decisions like that. When I talk about common sense lending, with an AI, based model, usually the applicant has to fit in a certain box or certain algorithms, to qualify for certain things. And a lot of times there's going to be, some certain lockdown parameters on AI where, let's say a loan would automatically be declined because the unit is 8 years old or the unit has 150,000 miles. An AI system that is built that around some of the parameters like that, it's just going to automatically turn it down. Versus when you have a human's eyes on something like that, you can make, common sense decisions on, whether you should approve or decline the loan. And, the whole common sense versus AI is kind of an interesting discussion because, I think, in several years and in the future, where you're going to see more AI lending. But, with regards to AI versus common sense, AI doesn't have, the member in front of them talking and hearing what the member is saying and kind of getting a feel and a read on the member and, what they're trying to do and what they're requesting, what they're needing. AI is going to just, have algorithms and have parameters on what it's going to approve or what it's going to decline, what it's going to counter versus, a human who has, that human aspect where, you're sitting down in front of the member, you're talking to them, you're getting a good feel for what they're trying to do and what they're trying to accomplish. And I guess maybe some emotion, maybe some of the comments that the members are making may go factor into that decision. I can't tell you how many times where I may have declined a loan based on what I've seen on a credit report, on a job history, and then the loan application comes back to me, and I get a little bit more of the story from the member and from the loan officer telling me, hey, this is what's going on. This is why they're trying to do this. And I start kind of re-looking at things, and it kind of goes back to the old mantra of credit unions where we're people helping people. And we want to try to help, our membership. So when I get more of the story and kind of can dot some I's and cross some T's and kind of reevaluate some things, when I hear these things, I'm able to make a better, more sound decision, in my opinion, versus say an AI model that is only going to make, decisions based on the algorithms and parameters that are set in that AI model.
Interesting. I guess I'm a little more optimistic than you are that Not that AI will replace all human judgment. Maybe some kinds of lending, maybe not. But I do think the strictness of the policies is due to the lack of ability to use lots of points of data in the model. And I think the beauty of AI is its ability to look at a more holistic picture, right? If you think about a traditional underwriting policy that has 10 or 15 characteristics, it might not be able to weigh off, in your instance, a super old vehicle versus a good credit score and a loan we would have made on the undersecured, because it's got hey, we don't do old vehicles. But an AI model can go, actually, in this circumstance, that's low risk. And I'm hopeful that you can actually have policies that are more inclusive, or, the automated decision, if you will, if I think of the natural outcome of the policy just being programmatized, that answer will become more inclusive, more accurate. Not that there may not be exceptions that you want to make for data points that you don't have, but that model can take more data points in. And the risk of lending this borrower the money unsecured and go, well, this is obviously something we should do. And that can be, there's no reason that couldn't be automated and seen in an AI model. In fact, I think you do see that with a lot of the lenders we work with. So maybe I'm optimistic that AI can improve the state of the art in kind of the standard policy outcome, and at the same time leave room for, a more holistic picture. Because obviously, some of my founders would argue that AI would completely be perfect in its decision making, but that would require that every piece of information available to a human be made available to the AI, which isn't a realistic. We don't have the fields for all those things, and so there will always be things where there's a story or an element of data that's not available to the model that could be, influencing how you want to make a decision. That's not that the model's wrong. It's just incomplete in the case of certain kinds of data or information or story that it just doesn't have access to.
Sure. Now, like what you're saying with that, I do see in the future as AI advances, from an underwriting standpoint, I do see that, AI will be able to make some of those, adjustments and assumptions and, kind of evaluating the risk versus, what is at stake versus, with AI. I do see some of that's going to come into play. I do eventually see that, AI will be able to kind of recognize some of those things.
Yeah, we're working hard to make that true. So hopefully we'll bring that to fruition. I wanted to hop back to a category of lending you mentioned where you started off in the indirect side doing some underwriting. And I think the indirect lending is a really fascinating question. I think the nature of lending for automobiles has changed quite a bit during COVID. I think we see shifts as EVs come to market and the kind of power balance between OEMs and dealers and where the lenders sit in between those two things. And as models like Carvana or CarMax that are a little separate from the more traditional sales models come to fruition. So I'm curious what you see having changed during, let's say, the COVID time period when we've had really strange impacts to the sales of cars as well as the financing, and what you see kind of moving forward in the indirect space. Because I think it's a lot of lenders I see pulling back or curious or uncertain about what the future of automobile lending is going to look like, given the disruptions going on in the world of finance, but also specifically in the world of automobile sales and distribution.
Yeah, so I think COVID kind of taught us a lot about dealerships and indirect lending and, what was going on, because you saw once kind of COVID hit, you started seeing dealership inventories be affected. You started seeing, cars, gone were the days of a dealership having 500 cars on the lot, where now if you go drive around to most dealerships, you might see 30, 40 or 50 cars on a lot. And I think COVID had a lot to do with that. And the reason that is, and I think the manufacturers saw this, is instead of, having 500 units on a dealership lot, during COVID, the inventory issues were low. They were having trouble getting, chips in vehicles. Vehicles were sitting out without any chips. They were having issues, trying to get inventory out to the dealerships. But what they saw was that didn't stop the customer from coming in and buying a vehicle. No, instead, the customer would come in, put a down payment on a vehicle and have it ordered. And then the vehicle would come in a month later and they would go buy the vehicle at that point. And I think that's kind of some of the adjustments that you see. And because of that and the supply issue chain, prices went up, valuations went up on automobiles. And I think manufacturers saw that, and they saw that, well, hey, we don't have to have, all these units on the lot because we're still doing great in sales. Our overhead's still really good. We're still making really good profits. And people are still willing to come in and buy a vehicle, whether they have to, wait for it for a month or 2 months or wherever that may be. And I think COVID kind of helped manufacturers realize that and see that. And so I kind of think you're going to start seeing some changes in the indirect landscape with dealerships, and one of the things that, I automatically point to is Tesla. Tesla has a direct sales to consumer line where there's no intermediary like a dealership to kind of, maybe sell some ancillary products and, have a pricing and, things like that. Tesla goes from Tesla to the consumer. You may have heard Ford is going to do that with their electric vehicles, where they're going to try the model of we're going to send vehicles from the manufacturer straight to the consumer and cut the dealerships out. Now, some of the peaks and valleys of this is, let's say for the state of Louisiana where we are located, there are not any direct consumer sales allowed for autos in the state of Louisiana. There is a law against that, and there has to be some type of subsidiary or intermediary like a dealership.
Can I ask, how does Tesla get around? I've always been curious about this. Like, I know those laws exist. I know that, the manufacturers seem to be working towards either direct sales for EVs, or at least I've heard like no negotiation, no haggle pricing requirements, or they're going to start to like dictate a little bit more of the customer experience and the sale price to the dealer. But how has Tesla gotten around? Do they just not sell in Louisiana? Do you have to drive to a nearby state to buy a Tesla? Or how do they actually manage to sell Teslas in the state?
If you want to buy a Tesla in the state of Louisiana, you can't. You have to go drive into Texas to go buy a Tesla.
I got to go pick it up in Texas.
Correct. And there are actually 15 states where direct sales to consumer are not allowed. Tesla actually sued the state of Michigan in 2016 because they had a similar issue, and it took them about 4 years for them to settle, but they eventually settled where they were able to sell vehicles through some type of subsidiary. Now, in the state of Louisiana, there's a similar thing going on. Tesla has filed a lawsuit against the state of Louisiana. They've filed a lawsuit against the Louisiana Dealers Association and certain motor vehicle commission that they believe that some of those people are entering in an unlawful conspiracy to bar Tesla from doing business in the state of Louisiana. And that is an ongoing lawsuit right now. So they're trying to, be able to sell vehicles in the state of Louisiana. And there's obviously going to be some other things at play with, kind of people coming together trying to go against Tesla to kind of keep them out of the Louisiana market.
Fascinating. So sorry, I didn't mean to interrupt, but
No.
You made that point. And I was like, I've always wondered how this worked and what the reality was. So how do you as a lender think about how you deal with this kind of changing landscape for what's happening with the sales and financing of cars? I mean, it's got to be, I imagine, shifting what lenders are expecting or able to do in that space.
Yeah. So in the state of Louisiana, EFCU Financial is one of the top indirect lenders in the state. We do a great business with our dealership landscape, and it does concern me a little bit from an indirect lending standpoint. You're seeing Tesla's at this model. CarMax has a similar model where CarMax only uses national lenders. They won't use any local lenders. They have a no haggle pricing method where you go straight to CarMax. The price is what the price is. There's no haggling versus, going to dealerships, you're haggling on prices, you're haggling on ancillary products, things like that. But, when you see Ford, a major manufacturer who, produces the most trucks and sells the most trucks in the country, including the state of Louisiana, talking about going to a model like this, that basically cuts out, a portion of indirect lending, because indirect lending is based on, dealerships and, the consumer going to the dealership, applying for a loan after they've picked out a vehicle. And that application comes out to, several different lenders, one being us. And so it is a little intimidating to see that. And honestly, I think if Ford has the success that they think they're going to have, like Tesla's, indirect could be in a little trouble, in the future. It will take a while for some of those manufacturers to adjust to some of those things, but you could see indirect lending cease to exist in 10 to 15 years if you start seeing more manufacturers go to this manufacturer to consumer model.
But what do you mean? Like even in Tesla, it may not be through the traditional rails, but like I bought a Tesla. I financed it. It was a really interesting experience for me because I went to my bank and said, I called the guy I work with at the bank. I said, "Can I get an auto loan?" "Well, you have to walk into the local branch and fill out." I said, "I'm not doing that. It's a Tesla, man." And I went online and they said, "Do you want to finance it?" I said, "Yes, I do." And they responded to me with a rate from my bank, who could not originate an auto loan for me digitally, but they were willing to fund the paper on Tesla's website. So I got a loan from my bank through Tesla, right? And I was like, I was really stunned, but they were still clearly, they were using an indirect model to work with lenders to offer loans to customers on the Tesla website. So there's still an opportunity there for lenders to some extent. I think Tesla works with a handful of just a couple of banks, right? A couple of big national lenders.
Yeah,
But,
and
at the end of the day, these guys don't want to, they want the cars to get financed and they don't want to be a bank. So
sure.
They're going to need to find partners to make that happen, I think.
And I think that's what you see with a lot of these national lenders like Tesla, or national dealers like Tesla, CarMax, Carvana. They don't like to deal, from my experience, they don't like to deal with some of the smaller community banks and credit unions in the area. They prefer to deal with the national lenders. And maybe that's an opportunity that's going to, pick up for some of the national lenders, like, your Cap Ones, your Chases and US Banks and Bank of Americas and things like that. But then when you really think about it, it starts cutting out the small guys, the small credit unions, your smaller financial institutions in these areas. And, that could be a problem for, smaller institutions going forward for something like that, when they're not willing to do business with a local lender unless, you've signed up through them through an indirect channel. But, you see like CarMax, who refuses to sign up, local lenders. They only deal with national lenders. And so they kind of cut the small guy out. And, again, if you start seeing some of those things like that, where we have to go, instead of going to XYZ Ford dealership down the road, we have to get in touch with Ford to try to contract them and get signed up with them through an indirect, subsidiary to do business with them, going forward, if they're going to kind of go to this direct to consumer model. But then, you look at it this way: Ford has their own financing. They have Ford Motor Credit. Who's to say they just hold on with Ford Motor Credit and just try to filter all of those applications straight to Ford Motor Credit and just cut out your national lenders altogether?
That's an interesting question. My experience with those captive lenders is that they are, I don't think they have the capital available to actually lend all of the Fords sold in the country, right? They're going to need some way to have at least additional depository dollars brought in to fund the loans. But my experience is they're also not as full credit spectrum as the sales arm of the manufacturer would like to be, right? Like ultimately, if you go to a dealer and say, "How do the captives do?" They go, "Well, they're great in the prime, super prime space. But if I get my near prime guy who's buying a used vehicle or a lower end vehicle, they don't support that, right? And I'm going to my local credit union who is willing to approve somebody who's maybe, has a bit more of a story and is willing to take a chance and look at a different picture than a credit score." So it'll be interesting to see if that plays out, because my history is that those captive guys are both short dollars and uninterested in the level of risk that's involved in getting into, the full spectrum of people who buy cars, because ultimately cars are not only bought by super prime credit holders, right? They're bought by a pretty broad section of the American consumer, including those with less than pristine credit. So it'll be interesting. I feel like they're going to still need partners in that space to help them, with both the capital and the ability to either take on or at least understand the level of risk that I think most of their systems are not used to trying to understand and estimate and deal with.
I would absolutely agree with that. I mean, they're definitely going to need capital if they were to try to do something like that, and they will probably try to partner with other institutions. But I think you would see them trying to partner with bigger institutions who have bigger capital to be able to offer them versus partnering with XYZ little credit union in the city of Baton Rouge.
Yeah. Do you think there is a play for CUSOs in this space? I mean, I've always thought that the CUSO model is interesting for credit unions, where they can kind of band together, create a bigger balance sheet in conjunction than any one of them has individually, and reduce the burden on whatever the partner is in terms of diligence and oversight to kind of like, the CUSO itself or one member credit union, and not 50, but then you can bring to bear the balance sheet of 50 or 100. Do you see something where the credit unions or local institutions band together in a way like that to kind of become a national player and be able to be of value to one of these larger institutions where they can get in the game?
Absolutely. Credit unions at the end of the day, we are competitive against one another, but when you have situations that you're describing like this and trying to, kind of band together and develop a CUSO to be able to compete with some of your national banks, I could absolutely see something like that happening, because at the end of the day, they may start ignoring the small guys. And if you band together and kind of come together as one conglomerate, one big CUSO, you're able to offer kind of the same things that maybe that national lender can offer. So I absolutely could see something like that happening in the future.
Yeah, I think it'll be really interesting to see how this plays out. It is certainly a fascinating space. And as you said, we've had a couple of disruptions that are unexpected. I mean, the supply chain, the lack of inventory was not necessarily something any of us saw. And it was pandemic related, but not in the kind of people wouldn't go to dealerships to buy cars way, but in like a total supply chain disruption. But it is kind of pointing the way towards maybe what the future of automobile purchasing and financing looks like.
Absolutely.
Adam, were there other topics you want to talk about? Did I miss anything on the list of stuff you prepared for to talk about today that you thought we were going to dive into?
That's about what I had. If there's something that you're open to talk, I'm willing to discuss just about anything, and I'm very knowledgeable. I can just easily roll something out.
No, I always like to ask that towards the end when I get through my prepared questions to see if I miss something of value. But if not, I do have my standard 3 questions that I ask everybody at the end of the podcast. So I would love to get your answers to them. You ready?
Yeah.
Rapid fire session. Okay. One, what's the best piece of career advice you've ever gotten? And I'm curious where it came from. Did it come from McDonald's or when you were a teller? Or what's it?
Well,
how did you?
Believe it or not, it actually came from my dad.
I like it.
So my dad, he's had a corporate job with a big chemical company for a long time. I've always trusted his judgment, and I always bounce things off of him when it comes to like a business perspective. When I have some questions, and maybe he gives me some good insight. And one day, I had a question because my supervisor came to me and wanted to give me some more work and responsibilities that may have been outside of my job description. And I called my dad and asked him about this. And this is what he told me. If your supervisor gives you more work or responsibilities, be open and receptive. They wouldn't give you more work or responsibilities if they didn't think you could handle it. Maybe they are prepping you for something in the future. Take it on, be willing to learn, and do it with a smile on your face. And I've kind of taken that advice to heart. And anytime that's ever happened, I've always kind of done that. And at the end of the day, it has helped prepare me for, future movements up the organization. And it has definitely helped me do that.
I like that. That's great advice. I've seen some movement now to they call it the quiet quitting and the not doing the things that aren't exactly in the job description. And there's certainly, I think, a value in placing limits on how much you work in your time. You can't just ask to do everything. But I do think when you get that thing that's outside, it's often an indication like, hey, I respect your capabilities. I need help. And it's an indication that you got a chance to distinguish yourself. And, it's also reasonable to ask for promotions or things when you're doing that. But I do think those are opportunities to really stand out versus the crowd.
Definitely. It lets you put a couple flags in your hat. So and it gives you that little nudge of, hey, I'm doing something extra, for you. And, we're doing, working on some extra things. And it kind of prepares you for the future of going forward.
Like it. Good advice. And dad advice is always good advice. At least that's where I get I've gotten a lot of my career advice as well. So I like that. Second question, what's the best piece of advice? Maybe we kind of cover these last 2 a little bit, but the best piece of advice about consumer lending. Maybe you're going to tell me it's use common sense. But,
that's where it is. And, like I said, I kind of prepped myself in the past few days for some of these questions. So that's exactly where I'm going to go. My best advice is approve the loan if it makes sense. Does the member show the ability, stability, and willingness to pay? Will the member ultimately pay this loan back? And anytime I'm making a loan decision, that's the last question I ask myself before I hit the approval button. Is this member going to be able to pay this loan back? And if the answer is yes, then approve the loan. Because 9 times out of 10, your instincts, as an underwriter, as a manager, reviewing these applications, typically your instincts are correct. And what I've seen by doing this and applying, some of my instincts and applying some of my methods to our lending, it's turned tenfold for EFCU Financial.
All right. So use common sense, even if it is not as common as we would like. Maybe develop some common sense if we don't have it yet. But it is a good thing. All right. My last question, what's one bold prediction for the future?
My one bold prediction for the future may not be very bold, but I foresee lending, underwriting to be all AI within the next 10 years. People want decisions instantly. They want everything instantaneous. We have a younger generation up and coming who, instead of waiting 5, 10, 15 minutes for a decision, they want it now. And as you see technology develop, as you see AI develop, you're talking about efficiency standards, quicker responses back to the member. And so I foresee with the technology development that we're seeing, around our country and the way things are progressing in lending, I think in the next 10 years, you're going to see underwriting basically go to all AI. And I think it makes for better for efficiency for financial institutions, and it makes for a better experience for the member and the customer.
The 10-year timeline is interesting because it reminds me, there's an old, I think it's an Alan Kay quote, says we always overestimate what technology can do in the short term and underestimate what it will do in the long term. I feel like 10 years is right in that long-term range where people go, I don't see it next year. And I go, yeah, but the 10 years, between 5 and 10 years, amazing things can shift in that time period that can seem unrealistic at the time. But I like that, all AI lending in 10 years.
Yep.
Beautiful. Adam, thank you so much for taking the time and sharing your perspective today. I really appreciated the conversation. And I'm sure the audience will as well.
Absolutely. Thank you for having me. I really enjoyed it. And I'm looking forward to hearing the podcast.